What are the chances that your mutual fund manager can beat the market? That's what I'm thinking about today. One of the things we espouse here at Trinity Financial Planning is index investing, not trying to beat the market, but getting market returns. And I came across a chart recently that really speaks to that. We haven't talked about that in a long time, and I wanted to bring that up here. We'll pull it up, and there's sort of two charts on here. First of all, I want to focus on the bars over on the kind of the left-hand side. We'll get to the circle in a little bit. On the left-hand side, you can see the number of funds, right, that have beaten the S&P 500, which has averaged about 9.5% going back for that time period. And when you take a look where that sort of orangey line is that indicates the S&P 500, that's right on the right-hand edge. So we've got two sets of data that were just to the left or just underperformed. Close to 100 mutual funds came really close to the S&P but underperformed. And everything on the left is under, and everything over on the right are funds that outperformed. And it comes out to be on that chart about 75%, about 3 out of 4 are over on the left-hand side there. Right, they're underperforming. When I first looked at it, it looked a little bit odd, like it was more balanced, but that S&P number is not in the middle of that sort of bell curve, right? It's to the right of that. So 3/4 of funds underperformed, and you see this or you hear it a lot, right? Only 25% of funds outperform just getting the S&P 500. So then you should index, right? That totally makes sense. Let's just get the market return because you've only got a 1 in 4 chance of picking the right fund that beats them. That beats the market. The circle over on the right, that tells part of the story. That circle over on the right, though, is really, really interesting. The green shaded spots there, right? That shows that 3-to-1 ratio of funds that have outperformed the S&P 500. But what that 3-to-1 ratio, or that have underperformed, the 3-to-1 ratio doesn't discuss or doesn't include is all the funds that went away during that 30-year period. And that's what that gray section is, right? Check that out. 59% of the funds did not survive, meaning they went away. So of the funds that survived, 1/4 of them, 1 in 4, beat the S&P 500. The other 3/4 did not beat the S&P 500. But it's not like you had a 1 in 4 chance of picking the right fund. When you take a look at all the funds that went away, it's something more like a 1 in 10 chance, right? And think about what this means. Those 60% of funds that went away. Why did those funds go away? Was it that they were doing so well and making so much money and people couldn't wait to invest in them that they closed the fund and disbanded it? Not likely, right? What are those funds? Those are the funds that went, and you know what? We're just going to wipe that off the slate. So we're going to talk about, hey, we're one of the, you got a 25% chance of beating the market. Why don't you invest in our actively managed fund, right? That's what the data shows in the bar chart. Hey, yeah, it's you got a 1 in 4 chance, but we're the 1 in 4, right? We know what we're doing. We've got this top-down analysis, this bottom-up, whatever it is. That pie chart over on the right, that really shows the difference. Right? It's not 1 in 4 chance. It's, you've got a 6 out of 10 chance, more than 50% chance that the fund that you pick is actually not even around anymore. And again, why is that? Not because it was doing so awesome, right? So again, we don't talk a whole lot about specific investments in here or philosophies, but certainly buying index funds, getting the market returns, right? Not trying to beat the market. That's really the way to go. So that's what I'm thinking about today. As always, interested in knowing what you're thinking about. If you're watching this on YouTube, drop a comment in the comment box or shoot me an email directly. And as always, thanks for watching.